Hey, guys, and welcome to another session of Short-Term Metrics, the only channel that is here to provide you with helpful insights to become a better investor and a day trader. So, please, guys, we are new here. We're trying to give it our very best. So, just give us a like, a subscribe, tell us what you want us to talk about, and we will do it. So, this is the discussions we have had so far. We take this very seriously and we want uh, to become better trainers. That's why we have this YouTube channel, and I welcome you to subscribe to our channel and enjoy with us. So, if we continue, China deflation risk puts focus on the US CPI. Before we continue and dive deep in, let's watch this. And perfect.
Eddie Van der Veld joins us from.
Oh, 1 second. Let me fix this one. Perfect.
The Markets Live team. Eddie, good morning to you. So let's get back to the China theme, I suppose, because that flirting with deflation line has in the past had global resonance and relevance.
Absolutely.
Does it now?
Yeah, and look, China flirting with inflation is definitely the big story, particularly because China is still the factory for the world, and it is an exporter of inflation. But what really caught my eye is not that PPI number, not the factory gate number. It's the core inflation number, because that started coming down, which is not something that we've seen in the rest of the world. And of course, all of this will, push for more stimulus for Beijing, which has really been a very, very piecemeal. Now, it's tempting to think that where China leads us, the rest of the world will follow. But it's not at all clear that that is the case, because, when you see supply chain disruption, you see these shocks coming through the economy, you don't see necessarily that that it stays there.
Okay, guys, so the general idea is that wherever Chinese economy, China's economic growth is heading, then so is the rest of the world is heading, meaning China and the US are leading the inflation and what happens in the economic playbook. So this guy right here says, okay, we all know that it's very likely that China will make other markets and states follow, but he says that it doesn't necessarily needs to happen in that way because supply chains are disrupted and a lot of variants coming into play with these sorts of behavior. So let's continue.
What happens is it feeds through into wages, and when it hits wages, that's when it becomes sticky.
Well, on the question of wages, do you have any more clarity as we loop back to the numbers that came out of the US on the jobs front? We had the shock ADP number, then the non-farm payrolls, 2009, 209,000, so below the estimates. What is your estimate now, your expectation as to how the jobs market in the US unfolds? How much clarity do we have about the progression?
Yeah, Tom, it was a very confusing picture that we had last week, right? We had the ADP numbers faking to the upside, and then we got the non-farm payrolls coming in lower, really, than many people had expected. But the jobs market overall in the US still looks quite strong. And we saw that particularly in the wage inflation, which is still very strong, right? And I think that as long as that is the case, that the Fed will continue to push for hikes because wages, like I said, is where it becomes sticky. And I think the Fed, therefore, and where the markets are still pricing in a hike in July.
Yes, and it seemed to be that focus on wages out of all of that data on Friday that spooked the equity markets a little bit. So they certainly were concerned about that, as you point out, Eddie. Let's pivot to the UK, another part of the world where we're concerned about tight labour markets, although some really interesting news out of KPMG and our.
Okay, guys, so as we can see here, we can see that the US CPI is very much reliant on the deflation in the Chinese economy. Because if the Chinese economy, if China's government will stimulus the economy, meaning there is a lot more exports going on, and when a lot more exports going on, meaning that consumers are spending more, particularly in the US, because this is the largest market share that China has in terms of um, exporting. So if China's growth is going if China is stimulating the economy, then it means that people will spend probably more in the US, which will cause a bad effect on inflation and will make it still very sticky. Um, so that's about that. Let's go over to this one right here. So this is in Channel News Asia. This is the website. I got into an article right here. So Asian shares rose and the safe haven dollar edged lower on Tuesday as investors hope this week's US inflation data supports an imminent head end to rate hikes and cheered the prospect China will deliver economic stimulus to prop up stalling growth. Remember, this is maybe making people to believe inflation is down. This is maybe giving us a sign that we can continue and spend, but things are not all right, okay? This is way too early to do this. We need to get into a recession. We've been talking about it in the previous videos. Let's continue. Markets are awaiting US inflation data due on Wednesday to see if price pressures are continuing to moderate, which could provide clues on the interest rate outlook. Investors were digesting comments from several Federal Reserve officials on Monday who said while additional rate hikes are needed to bring down inflation, the end to the central bank's current monetary policy tightening cycle is getting close. Data shows that a steeper than expected decline in Chinese producer prices on Monday suggests that the country's post-COVID rebound has run out of steam. But added to expectation that policymakers may need to do more to shore up demand, said ANZ analyst. So what we can see that the stimulus that the Chinese government has pumped into its market due to COVID, post-COVID relief package, which they did, added to expectation that the 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 government will need to do more stimulus, okay, which is not the very best thing to do. Analysts said while the extended policy could ease short-term financial pressure on property developers and ensure their home project completions, new measures would be needed to tackle the cash crunch in the sector, meaning stimulus. The current measures are unlikely to sufficiently stimulate home purchases and rescue the property sector. Beijing may need to take more action to arrest downward spiral. So, as you guys understand, this is really affecting the CPI because if China is dropping its prices, then it will probably mean that the CPI will go down because US is the biggest consumer from the Chinese market. Hope this one helped for you guys. I'll be here for another session to help you understand about the economics and how to approach the charts knowing your macro environment. So please make sure to comment if you like this video, and if you want if you want us to record other videos, please head over, like, subscribe. We are here to stay and we will bring on the fire each and every day to any one of you. Peace, gang.